Welcome back to this channel. This is Unfiltered Forex with me, Clement, and in this video, we'll be talking about shareholders' equity. This is what I believe is going to be the third and final part of talking about the balance sheet. And yeah, this is also the last part of the balance sheet. So, what is shareholders' equity? This is what a business is worth after all liabilities have been paid off by the assets. Okay, remember the accounting equation, which is assets equals liabilities plus equity. So to calculate the shareholders' equity, it's the difference between assets and liabilities. The initial amount invested in the company equals shareholders' equity. Okay, that's the initial amount invested in the company. And of course, any additional amount that is invested in the company usually comes in through the shareholders' equity. Okay. Net income also flows into the shareholders' equity because net income is income after all expenses have been paid off. So it falls under the shareholders' equity as retained earnings. Okay. Now we'll get to that later, talking about retained earnings. But for now, just get the overall view of what the shareholders' equity is. Now let's go over to an actual balance sheet and see what the shareholders equity looks like. Okay, for this one I will be reviewing the balance sheet of Apple. Yeah, I will also pick some as we go, but I'll start with this one. Okay, before we get to the shareholders equity, this is now the balance sheet itself. You can see assets, liabilities, and shareholders equity. And then down here, shareholders equity total $62 billion. Okay, this total liabilities plus shareholders equity has to balance with the value of the assets. Okay, you can see here total assets 352 billion 583, and also total liabilities and shareholders equity same number. Okay, yeah, they have to balance. That's why this is called a balance sheet, because it balances the books of the company. Okay, yeah. Now, as you can see here, the shareholders' equity is quite a small summary. Common stock and additional paid-in capital, par value 50 billion, shares authorized 15 billion, 15.9 shares issued and outstanding respectively. And then accumulated deficit, accumulated other comprehensive loss, total shareholders' equity. Okay. So let's go on to the final part of the balance sheet. You can see there's a consolidated statement of shareholders equity. This is the same as this one. Okay, it's this part, shareholders equity. This statement, it's this part, shareholders equity. It's just that some companies prefer to list it separately as its own thing. Okay, so total shareholders equity beginning balances. Okay, so all these values are in millions except per share amounts. Okay, yeah. Common stock and additional paid in capital. Common stock, this is now the stocks of the company that are traded in the open market. Common stockholders have voting rights in the company. Okay, and they earn dividends. So whenever the company is paying out dividends, they pay out dividends to common stockholders. Okay, and in the priority ladder of stockholders, there are bondholders, preferred stockholders, and other debt holders. Okay, let me go over to another format of the same balance sheet to show you the other types, but they have not been listed here because this company doesn't have them. Here we are. You can see here there is a row for preferred stock and it's blank. Okay, because this company doesn't have preferred stock. Okay, that's the thing. Back to here, common stock beginning balances. This beginning balance is carried forward from the previous financial year, from the previous fiscal year, and that's what's the beginning balance for the current year. Okay, You can see there is even a definition here of what this is. Okay, common stock issued. This is now new stock that has been issued by the company. Okay, new stock. As you know, companies do raise money by issuing new stock. So whenever they issue new stock, they sell them and get money for their operations. Okay, so this value is showing that the beginning balance was $64 billion in common stock for the previous financial year. This is the beginning balance for the latest one, and they issued an additional $1 billion in stock. Okay, 1.3 billion. Then common stock withheld related to net share settlement of equity awards. Okay, this now is a tax. Okay, common stock withheld. This is a tax. Let's click adjustments related tax withholding for share based compensation. That's the tag it has because this is a tax. All right, and net share of settlement of equity awards. There are companies that do pay out shares to their own employees as a compensation program, mostly to boost the employee morale and to give them a say in the company's decisions. So, yeah, in most tech companies, this is a very common practice, especially in recent years. Most tech companies, both startups and even the well-established companies, they do pay out compensation. Yeah, they do give out stocks to some of their uh, employees. Okay, now that stock that the employees receive is also taxed. Okay, and this is the tax here now. And share-based compensation, this is it. Okay, yeah, $11 billion in compensation, and there was some tax on that. Okay, the ending balance $73 billion. Remember, this is if the balance is in bracket, it means it's a negative. Okay, so from $64 billion, we add a billion, subtract 3 billion, add 11 billion, get $73.8 billion. Okay, that's for common stock and additional paid in capital. Okay, the additional paid in capital part is coming in from the new stock issued. Okay, now we come to the retained earnings or accumulated deficit. So remember, if a company under these two scenarios, okay, if a company doesn't retain any of their earnings, like if they reinvest all of the earnings, there will be zero retained earnings, and there might even be an accumulated deficit. A deficit now is from the retained earnings, you spent all of your retained earnings and even used some of the shareholders' equity to do your thing. Okay, that's where the deficit comes from. So the beginning balance is here. You can see this was already a deficit from the previous financial year, and even the beginning balance of this financial year, it started off this time there was a retained earning of $5 billion. But last year, at the end of last year, the previous year rather, there was a deficit of 3 billion which was carried forward into the latest financial year as a beginning balance. And then net income. Okay, this is also coming from the income statement. The net income, which is the income after the company has paid out all of their expenses. Okay, the net income was $96 billion, $96.9 billion, and then dividends. Okay, some companies do pay out dividends, some don't. Okay, this company, you can see they pay out dividends, and the dividends came to $14 billion. The dividends come from the net income. Okay, so that's why it's under this category: net income, and then dividends paid out, and then common stock withheld related to net share settlement of equity award. Same story with this other one. These are tax, but now this tax is coming from the net income. And then common stock repurchased $77 billion. So common stock repurchased, this is a buyback program. Okay, meaning out of the common stock available traded publicly, the company may decide to buy back some of their shares to reduce the supply of shares in the market. Okay, for this one, I have to take a detour and explain a bit what this means. Okay, we'll start with a simple example. Let's say a company's share price is $50 per share. Okay, $50 per share, and the total available shares in circulation is 5,000 shares. Okay, so there are 5,000 shares outstanding which are available in the market, and the stock price is $50. And let's say for you, you have 10 shares. Okay, so let's say the company decides to add more shares into the market. Okay, let's say they add 2,000 shares, they issue 2,000 shares to raise capital. Okay, so now there are 7,000 shares available. Okay, but you still have 10 shares. In terms of equity now, what happens is your 10 shares as a percentage of this 5,000 is not the same as your 10 shares as a percentage of 7,000. Let's do the math. So out of your 10 shares, you divide that by 5,000 times 100%. What do you get? 0.2%. Okay, so this 0.2%, this is your stake in the company. This is how much of the company you own when you have 10 shares and the total outstanding shares is 5,000. Okay, so what happens when they increase the number of shares to 7,000 and you still maintain your number of shares? The thing is 10 divided by now 7,000 shares times 100%, 0.14%. Okay, so you can see with the same amount of shares, if the company decides to issue more stock, your stake in the company reduces. Okay, if they issue more stock with you maintaining the same number of shares, your stake in the company reduces. Okay, the term for that is called dilution, meaning your shares have been diluted. And this is something you need to be careful when you are trying to invest in a stock. See how often they are diluting their shares, because it's it's not a good thing. Okay, yeah, they may be doing it to raise capital for expansion, but if they are diluting their shares a bit too much, is not ideal to invest in that company. Okay, now let's go back to Apple. Common stock repurchased. Now this is a buyback program. Okay, this is reducing the supply of shares in the open market. Let's go back to our example and now discuss what a buyback is. So essentially, now let's talk about a buyback. A buyback is reducing the number of outstanding shares available. Okay, starting balance of 5,000 shares available and you still have 10 shares. Let's say the company reduces the amount of shares available, they take back some of the shares. Let's say they reduce the number by 1,000, so now there are 4,000 shares available. So what's going to happen now? It's 10 divided by 4,000. The result is 0.25%. Okay, so you can see, comparing this result to this one and to this one, now you have a bigger stake in the company just because the company decided to buy back some of their shares from the open market. Okay, now there are 4,000 shares available and you still have 10 shares, so your shares now are worth more. Okay, now this is the opposite of dilution. Okay, they're trying to reduce the amount of shares available in the open market, trying to now make their shares less and less available. Okay, yeah. The importance of doing this usually is for companies, of course, to raise money without issuing more stock. They now start buying back some of the stock available, some of the stock they had previously issued, and now once they have bought it back, they will now sell again at a higher price in the future. Okay, They might selling might be in the future plans, but not short-term foreseeable future. No, because this is a long-term strategy, like in decades, measured in decades. Okay, let's check the number of outstanding shares for Apple. Okay, here we are. This is a chart of total number of shares outstanding from Apple. Okay, shares outstanding for the quarter ending March 31st, 2024 were 15.4 billion. And yeah, you can see the website here, macro trends, Apple shares outstanding. Yeah. So Apple was started in 2009. Okay. Between 2009 and 2013, they were increasing, issuing more stock. Okay. Not every year, but for most of the time, they were issuing more stock. Okay. So yeah, between 2009 and 2013, they were issuing more and more stock. This is March 2013, in fact, March. And then again, now from July, and this is from June 2013 up to current, they started a massive share buyback program. Okay, they started buying back some of their shares. Okay, every time you can see the number has been consistently falling. Okay, this is now showing that these guys have been reducing the supply of shares available. Okay, now if we see here 2023 September. Okay, yeah, this is 2023 September. Shares outstanding 15.8 billion. If you come to the balance sheet, it's listed here at the top. Shareholders' equity, common stock, and additional paid in capital. This is the par value. 50 billion shares authorized. This is the total number of shares in existence for Apple. Okay, and 15.5 billion. This is the shares issued and shares outstanding respectively. Okay, so this is now the number of shares available in the open market. Okay, and you can see this 15.5 billion is the 15.5 billion here at the end of the fiscal quarter of the fiscal year 2022. Okay, no, 2023. Yeah, September. Yeah, so a buyback program is reducing the number of shares in the available in the open markets. Okay, still on the retained earnings part, you can see the buyback come is done from the net income. Okay, so what this now the summary what this means is, out of all the money Apple made in the fiscal year 2023, they paid out dividends, they paid out taxes, and they did a share buyback with the rest of the money. Okay, they did a buyback and even added on to the previous deficit. Okay, the deficit was reduced a bit. You can see now it's smaller than it was at the end of the previous financial year. Okay, and then accumulated other comprehensive income or loss, beginning balances, mm, ending balances. That so yeah, this is other incomes or losses that have come as a result of the business operations. Okay, there's something I haven't talked about. Okay, it's something called the book value. As you can see here, the common stock. Okay, the common stock, this 15 billion dollars, not dollars, this is 15 billion shares. These 15 billion shares, what they are worth on the balance sheet is not the same as what they are worth on the open market. Okay, so there's a book value of the share price and the book value of the market value of the share price. Allow me to talk about that. So the book value, which is also commonly known as the accounting value, this is the value of a stock according to the balance sheet, right? And the book value is calculated by dividing the equity by the shares outstanding. Okay, the equity, remember, is the difference between assets and liabilities, and then you divide that equity by the number of shares outstanding, the shares that have been issued in the open markets for trading by the company. Okay, so you divide the equity by shares outstanding, you get the book value of each share of the company. Okay, and something you need to remember is that the equity here can be diluted. Okay, diluted. Now we're not talking about the issuing of more shares, we're talking about the intangible assets on the balance sheet. You remember some assets can be overstated, especially the intangible assets. Okay, so and once those intangible assets have been overstated, it brings some issues when trying to calculate the actual book value of a company. Okay, if you try to assess the book value of Apple as at the end of the financial year 2023, what you're going to do is you're going to take total shareholders equity and then divide it by number of shares outstanding at the time of reporting. Okay, this is the number 15.5. So you divide this 62 billion by 15.5 billion. Let's do that. Here you can see I have also rounded up my figures to summarize them in millions. Okay, because in the balance sheet here these numbers are in millions. Yeah, in millions except per share amounts. This is in millions. So then remember what we said. This is if the numbers have been stated to be in millions, this means this 6 million, this 46 million, this is 146 million, this is 2 billion. Now the whole number is 62 billion 146 million. Okay, so you divide this, now converting also this number to be in millions, you just take out the first three place values. Okay, yeah, because these numbers are already in thousands. Okay, yeah. Okay, coming back to here, you divide the number by the equity by the number of outstanding shares. This result will give you 3.99. This is now in dollars. This is now the value of each share. Okay, and you can round this up to $4. Okay, so this means as at the end of the fiscal year 2023, the book value of the share price of Apple was $4. But if you go to the market, of course you will find a different price. Let's check. As you can see here, this is the chart now. On we're talking about September 30th. Okay, so September 30th, 2023, the share price of Apple was at around $171. No, this is, yeah, $171. That was the closing price of that Friday. So now this is the book value and this is the market value. This is $4 and this is $171. The difference between book value and market value is that the book value, as you have seen, this is the accounting value. This is coming from the balance sheet. But the market value, this is coming from investors and speculators. Okay, this is what the market thinks the stock is worth. Okay, in terms of, because this is a forward looking price. Like if you think, or if investors in general they think Apple is going to do good, they will buy more shares of Apple, and that's going to increase the demand and in turn increase the price of the the share price. Okay, so this is a forward looking value, but this is an accounting value. It's common for stocks to be above their book value because companies tend to do good in the long run. So that good news is, or that positive outlook is being priced in even before it actually comes. Okay, and there's something called a price to book ratio. If you check the main financial statistics that analysts do check. Now, instead of going through the whole balance sheet, like we said, there are the ratios, and now this is another ratio we're bringing in. It's called the price to book ratio. Let me write it here. The formula is market price of the stock divided by book value. Again, still on the same website. If you come here on the company profile, you're going to see those statistics. Okay, let's scroll down. You can see PE, current profitability, this is the valuation. Okay, and then there's the price to book ratio. This is that ratio of the book value versus the market value, market price. Okay, now since we had already calculated both the book value and we already got the market value, you can divide the two and see the value you will get, the ratio. The result is 42.75, which can be rounded up to 43. Okay, you can see it's close to this one. Yeah, probably because we rounded up some figures in our calculation. So yeah, but it's the same number. 42, 42, we have 42 here, and yeah, my figure is also 42. So yeah, the calculation was correct. The price to book ratio, this means that the current share price in the open market as at the end of the fiscal year, the latest fiscal year, is 42 times what the accounting value is. Okay, and whether this value is high or low, okay, there is an industry benchmark. Okay, and like we said, a high ratio means investors are optimistic about the company's future. But even in the optimism, there is a there is a range of how much good news is priced in per industry. Okay, because some industries in general are forecasted to do so well, so companies in that industry generally will have high ratios. Okay, so there, at that point there will be an industry average that is different from another industry. If the price to book ratio is high according to the industry benchmark or the average the sector, yeah, that's considered very good news. If the price to book ratio is low, investors are pessimistic about the company's outlook, low compared to other companies in the sector, or rather the industrial average of the ratios. Okay, and if the price to book ratio is below 1, now that is a red flag. That could mean it's the opposite of when it's high. Now that means the market is trading below book value, and it means bad news is on the way. Like most of the times, it means the company is not going to do well. Okay, like, for example, upcoming write-offs from the balance sheet. When some assets are going to be written off from the balance sheet, like a significant portion, then at that point the market price might go below the book price. Okay, like you remember the intangible assets, the goodwills and stuff. Yeah, and some uncollectible receivables. Yeah, those numbers, once they are written off from the balance sheet as assets, the share price may fall below the book ratio. Okay, but that's not very common. I don't know if I can find a company that has a extremely low price to book ratio. Let me see. This website is a stock screener. Okay, a stock screener, as in you can see all the stocks here, and you can filter to see the kind of stocks you're looking for. Okay, like we said, in this industry, okay, rather in these markets, what's usually used is the ratio. So if we come here, fundamental, now you're going to see the ratios. You can see this is the P ratio, price to cash ratio. This is the share price divided by cash and cash equivalents of the company. There's also payout ratio. We're going to go over these ones later, but for now, I am looking for the price to book ratio. This is the one, PB. Okay, you can see here, price to book ratio. This is a ratio used to compare a stock's market value to its book value. So if we compare low below 1, yeah, you're going to see companies whose price to book ratio is below 1. Now you can see the kind of industries that these companies are. This is mostly healthcare. You can see a lot of healthcare here, even real estate. This is quite terrible. Energy, this is a red flag. There's a big red flag. But yeah, you can see in some industries, it's not uncommon for the share price to be below the book value. It's not uncommon. And as you can see here, even the stock prices for most of these companies, you can see on the small chart that's coming up here, you can see most of these stocks are actually falling. Okay, very few of them are picking up. Stocks are actually falling because of the pessimism. Okay, this is pessimism that's being priced into the stock. Future bad news that's being priced into the stock. That's why the book values are below 1. Okay, remember, this is the price to book ratio. Okay, going back to the balance sheet now. Yeah, and I think we're done. So now something else is to check. Yeah, I have to check this one here. Okay, so now this is Seeking Alpha. I'm sure you remember this is the same balance sheet like that one. This is for Apple, and down here on supplemental items, you can see they have written there. They have given you the metrics. Okay, this is the total common shares outstanding. Like we said, 15.5 billion. These numbers, remember, are in billions. Yeah, no, in millions rather. In millions of United States dollars, except per share items. Okay, so but total common shares outstanding. These are 15 billion shares. Okay, cash per share. This is cash equivalents divided by number of shares outstanding. Okay, yeah, then you can see the book value and the tangible book value. Like I said, when trying to calculate the book value, the equity, it's the equity divided by shares outstanding. Equity divided by shares outstanding. And usually to get a true book value or a clearer book value, you need to subtract the intangible assets from the equity. Okay. Yeah. And as you can see here on this website, they have stated clearly that there is a book value for all assets and tangible book value per share. You can see the number is the same because I'm sure you remember Apple didn't have any intangible assets. They didn't record any, and that's a good sign. Okay. Yeah. So the book value per share, tangible book value, intangible book value per share, and then total debt, net debt, land, machinery, total full-time employees. These are supplemental items, but essentially it's important to monitor the what do you call them? The ratios. Okay. Okay. Talking a bit about cash per share. You can see there's a definition there. Cash per share is the broadest measure of available cash to a business divided by the number of equity shares outstanding. Cash per share tells us the percentage of a company's share price available to spend on strengthening the business, paying down debt, returning money to shareholders, and other positive campaigns. Okay. Okay, the formula for calculating cash per share, it's already listed here. It's dividing the cash and cash equivalents by the total number of shares outstanding. So we're using 2023 numbers. So we first have to take the cash and cash equivalents number. This is it's called, yeah, cash and cash equivalents. This is $29.9 billion. Let's write that somewhere, and then we divide that by this number, total common shares outstanding. Okay. Yeah. 29,965 divided by 15,550. And the result you get is 1.927. Okay. This is can be rounded up to 1.9 to 1.93. And you can see that number is what has been listed here, cash per share, meaning, and you can see what the book value is here, meaning this is the cash per share available to the business, meaning for every share outstanding there is $1.93 available. Okay, yeah, which is good. It's at an acceptable level. Like if for example Apple had more shares, okay, more cash on hand, let's say this 29 billion, let's push this number up a bit to 129 billion. Okay, so if it comes to 129 billion, if it comes to 129 billion, the cash per share will be $8 and 36 cents. Okay, this can be a problem. A problem why? Because this indicates the company has too much cash on hand. Too much cash on hand, meaning this is cash that is supposed to be spent to improve the company. This is money that is supposed to be spent for research and development, purchasing and moving assets, paying down debts, buying back shares, and yeah. So you can see if the ratio was too high, it could mean the company is not essentially spending their cash so well. But if it's high, like above one, it's considered good. Okay, yeah. Again, there is usually an industry benchmark for these numbers. So don't worry if you haven't understood now, you can understand later as you go through different stocks and see how different companies handle their financial. Okay, I think that's it for this video. I hope you found it helpful. With that, I am done with the balance sheet items. Other ratios that can be derived from the balance sheet, I haven't talked about them, but I will cover them in a separate video at a later date. Okay, yeah, I will cover them in a separate video later. But for now, that's it. Thank you for your time.